So, how does an expert analyst take a huge mountain of data and boil it all down to a simple buy, sell, or hold? Well, today we're basically going to become financial detectives. We're going to follow a real world analysis step by step to see exactly how a company gets put under the microscope. Let's dive in.
I mean, that's the million-dollar question, right? And here's the thing. It's not about just having a gut feeling or getting some hot tip. No, it's about a methodical investigation, a process of gathering and weighing the evidence. And that is exactly what we're going to do today. And for our investigation, we've got a case file on Caplin Point Laboratories. Now, they're a pharmaceutical company, and based on the analyst report we're looking at, they have a really fascinating story. So let's open up this file and see what we can find. Okay, first things first. Before we even think about looking at a single financial number, we have to understand the business itself. What do they sell? Who are their customers? How do they actually make money? This is step one, getting our boots on the ground. So what is Caplin Point's whole deal? See, they're not just your average drug company. They've carved out a very specific niche for themselves. They focus on getting affordable medicine to what are called regulated emerging markets. We're talking primarily in Africa and Latin America. You can think of it like this. They're willing to go where a lot of the bigger companies won't, navigating these really complex environments to serve a huge growing need. So how do they actually pull this off in such tough markets? Well, they do it with what analysts call a competitive moat. It's kind of their secret sauce, They have this deep expertise in all the local regulations, they've already built out a distribution network, and they have a real boots-on-the-ground understanding of the local markets. These are advantages that are just incredibly difficult for any competitor to come in and copy. All right, so we get the business model. It's solid. Now, let's see if the company is actually healthy. We're moving on to the financials. It's time for a checkup, checking the vitals. And just like a doctor checking a patient's pulse and blood pressure, we're going to look at some key numbers to figure out the company's financial health. And our first vital sign is return on equity, or ROE. And wow, 22.8%. To put it simply, this number shows how good the company is at making profits from the money invested in it. For a little context, anything over 20% is usually considered excellent. So this number is telling us that management is incredibly efficient. That's a very, very healthy side. Next up, let's talk growth. For 5 years straight, the company's revenue has grown by an average of over 15%. Now, this isn't some one-time fluke. This is the kind of steady, strong growth in sales that tells you their strategy is really working and their market is expanding. And finally, let's check their debt, because a company with tons of debt can be a big risk. Caplin Point's debt-to-equity ratio is just 0.28. Generally, any number below 1.0 is considered pretty good. So this is remarkably low. It means the company is funding its own growth with profits, not by borrowing a ton of money. That's a sign of a really strong and stable foundation. Okay, so the business model is solid, and the financials are strong. The patient is officially healthy. But what about the future? That brings us to our next step, looking at the road ahead to see the potential opportunities and, just as important, the risks. Every company faces a mix of tailwinds pushing them forward and headwinds holding them back. For Caplin Point, the positives are huge. They're expanding into new countries, and there's a growing demand for the affordable generic drugs that they specialize in. But the risks are real too. Dealing with different governments means regulatory headaches, currency swings can eat into profits, and of course, success always attracts more competition. A good analyst has to weigh both sides. Okay, let's recap. We've established that Caplin Point is a high-quality, growing, financially sound company with a really strong position. Sounds like a total slam dunk, right? Well, here comes the twist in our investigation, because a great company isn't always a great stock. Now we have to ask the big question. What's the catch? What's the price? This quote gets right to the heart of it. The stock is trading at a price-to-earnings, or PE ratio, of 29.2. That is significantly higher than the average for its entire sector. So what does that mean? It means the market already knows this is a great company, and it has priced the stock accordingly. We're not getting some hidden bargain here. And this table right here makes the whole dilemma crystal clear. Just look at the PE ratio column. Caplin Points is the highest of the bunch, but now look over at the ROE column. Its profitability is also the highest by a long shot. So the market is basically betting that its superior performance is worth paying that premium price. And that right there is the analyst's dilemma. So we've looked at the business, the financials, the future, and now the price. It's time for the final step, to weigh all the evidence and arrive at a verdict. How does an analyst take all these different pieces and put them together into one single conclusion? Well, they often use a scoring system, something like this. This particular report weights 5 different factors. You can see financial health and growth prospects get the biggest slice of the pie at 25% each. But these other factors, like competitive position, management, and valuation, are all critical parts of that final score. So where did our case file show a weakness? Right here. It's the valuation. I mean, despite scoring a really strong 8.5 on financial health and an 8.8 on its competitive position, its valuation score was the lowest of all the categories. That high price tag we've been talking about, it's actively dragging down the overall score. And that brings us to the final number. After crunching all the data, the model spits out a score of 8.1 out of 10. That's a proficient rating, which is very, very good. It confirms that, overall, this is a high-quality company. But a score isn't a recommendation. And here it is, the final verdict from the analyst, a hold, not a buy. And why is that? It's because even though it's a fantastic business, the current stock price already reflects that fact. The analysis suggests there's just not much upside from here, at least in the near term. A hold basically means great company, but you've probably missed the boat on getting it for cheap. And that leaves us with this single most important takeaway from our whole investigation. Finding a great company is only half the battle. The other, much harder half is buying it at a reasonable price. That is the true analyst dilemma, and it's the question that every single investor has to answer for themselves. When is the price of success just too high to pay?